Should I invest in dividend stocks? How to retire with dividend investing. Hey, how goes it? Welcome to Dividend Compounders with Cheese. In this video, we are going to cover the following topics. Number 1, what are dividends? Number 2, dividend snowball effect. Number 3, passive income versus active income. Number 4, what does retiring from dividends look like? And number 5, my recommendations. I genuinely don't want to see anyone working in their elderly age because of financial issues. It makes me sad. However, if you are young, you still have time to make sure you can retire with dignity and to relax in your older years. Retiring with dividends is not an MLM or get-rich-quick scheme like cryptocurrency. Rather, this is a path of diligence, discipline, and consistency. It sounds like a line in the John Wick movie series. Retiring with dividends will be slow, but it's worth it because of the compound effect. Your money invested in US companies will do the heavy lifting for you. If you are from an immigrant family, you probably understand this scenario. You work at a job, you make money, and you hold on to that cash, not doing anything with that cash. Just holding on to that cash is not enough for retirement. Holding on to cash is not the way to go because your $100 today will be like $75 in buying power 20 years from now. Let that $100 be worth $200 in 20 years. You can do that with dividend growth investing. Let's break this down even further and go into details. So what are dividends? The goal of a publicly traded company is to grow and make profit. The company can use those profits to grow more, such as like recruiting talent, launching marketing campaigns, expanding operations, or R&D. They can also use some of that profit to reward the owners of the company. If you own a company stock, you are known as a shareholder, and you are a part owner of the company, alongside with everyone else who owns the stock. So in a perfect world, when the company has extra cash, those profits are given to the shareholders as a reward for believing in them. Why do companies do this? Because they want to incentivize shareholders to buy more shares or to hold on to their existing shares. Also, a publicly traded company has to prioritize making their owners happy. And one way to do that is to give dividends. Some companies do not do dividends because they are still in the growing phase of their operations or they are struggling financially. So in short, a dividend is when cash goes from the company to its owners. When it comes to a dividend, there are certain metrics you want to look at. One is the dividend yield, and the other is the payout ratio. The dividend yield is the percentage the stock pays out in dividends annually. So if a stock is $100 and has a 5% dividend yield, then it pays $5 in dividends annually. You also want to take into consideration the dividend growth rate, which is how much the dividend is growing year over year. Why do we look at the dividend payout ratio? Let me explain. It's the percentage of net income a company pays out in dividends to its shareholders. Now think about it. If they are giving more than 100% of their net income away every dividend payment, do you think the company is healthy? Do you think it will be sustainable? No, right? How will they handle unexpected expenses, take care of maintenance fees, or manage compensation packages for the end-of-year reviews? That's why when we see Apple's low dividend payout ratio, it's a wonderful thing. When it comes to the dividend payout ratio, the golden rule is this: lower the number, the better. Because then the dividend has room for growth, the company has more cash to grow itself, and the risk of having the dividend cut is lower. Alrighty, so let's talk about the snowball effect and how it relates to dividends. We will be using Target as an example, ticker symbol TGT. Say you own 50 shares of Target, which pay out $4.40 in dividends per share, or $220 in total. You can use those dividends to buy more shares of Target and let the snowball compounding effect to occur. This is known as DRIP, and I'm not talking about someone's outfit being stylish, but it's known as a dividend reinvestment plan. You can use those dividend payments however you see fit, but letting it snowball is how the magic happens. So with the $220 in dividends from owning 50 shares of Target, you can buy 2 more shares of Target. So in the end, you have 52 shares of Target, and then the cycle just repeats itself again and again as it compounds bigger and bigger. Not only can you buy more shares with those dividends, but the dividend payments you get tend to grow each year. Do you remember how we talked about the dividend growth rate earlier? As companies grow, scale their operations, or become more efficient, their dividend payments to you will get bigger. Let's look at Target's dividend growth, for example. example. Back in 2013, a share of Target paid $1.58 in dividends per year. And as you fast forward throughout the years, Target has been increasing its dividend consistently. And as of last year, each share of Target paid you $3.96. In 2013, it was $1.58 in dividends. In 2022, it's $3.96. And when we break that down to the frequency that it's distributed at, which is quarterly or every 3 months, check this out. In May of 2021, Target paid 68 cents per share a quarter. And when you fast forward, it grew and then became 90 cents a share per quarter. And then it grew some more, and now it's $1.10 per share every quarter. Which means if you are a dividend growth investor, as time goes by, you'll be getting paid more in dividends per share that you own, which allows you to buy more shares. This is why we call this the snowball compounding effect. If you grew up in an area that snows a lot, you've probably made a snowball before. It starts out as a small ball in the palm of your hands, but if you roll it around in the snow some, it grows bigger and bigger. And that snowball can eventually turn into a snowman's belly. Likewise, the same is true with dividends. I'll show an illustration of this later on in the video. With that said, let's talk about passive versus active income. Active income is the wages and compensation you earn from putting time in at work. Your 40 hours a week are compensated hourly or through a salary. You need to actively produce or work to earn those wages. When it comes to dividends, it is a passive income, meaning you get paid regardless of what you are doing. You could be on the toilet after Taco Bell. You could be binge watching a new Netflix K-drama. You could be out for dinner with the family. And what's amazing is that you will still be paid dividends, regardless of what you do. If you are invested in a dividend-paying company, they will pay you. Passive income is awesome because it only requires one-time, upfront effort of researching which quality companies you trust and believe in. After buying those stocks, you just sit back and watch the passive income roll right in, like my legs and mosquitoes every summer. They just love the taste of my blood. Even when you are sleeping in bed like this dog, you will get paid. Maybe the tooth fairy was a dividend all along. Alright, so what does retirement with dividends look like? So we are going to forecast a retirement through dividend growth investing. And this is really going to show you the power of the snowball compounding effect. Some assumptions that we are going to make is that the dividends are going to be distributed quarterly or every 3 months. From my experience, I would say a majority of stocks pay their dividends every 3 months. And we are going to apply the DRIP method, which means reinvesting those dividends to buy more shares. We are going to start out with a principal amount of $2,000, which means you initially invest $2,000 into your brokerage account, and then you're going to contribute $1,000 every single month into that portfolio. Another assumption that we are going to make is that the dividend tax rate is going to be 15%. So I am going to go ahead and assume that you fall under this bracket right here. You are married, you and your partner together bring home somewhere between $94,000 and $580,000. That means your qualified dividends will be taxed at 15%. However, if you and your partner bring home less than $94,000, those dividends will be taxed at 0%. But for this exercise, we are going to tax it at 15%. The initial dividend yield is going to be 3.8%. The annual dividend growth rate at 5.7%. I just went ahead and used SCHD's 5.7% dividend growth rate, and then on average, we are expecting the portfolio to grow 8% per year, and our timeline will be 20 years. After 20 years of contributing $1,000 a month into that portfolio, our dividend balance in the portfolio is going to be $745,408.77, a total return of 208%, with our annual dividend payments being $18,587.64. Now, I'm going to show you why dividend growth investing is the best. So when we first start out with this portfolio, the growth is going to be very slow and steady. But once we hit year 10 and the balance is at $205,095.89, this is the pivotal moment where the snowball effect just really kicks in. Because if you fast forward 5 years, look at year 15. That $205,000 becomes $400,000. And when you fast forward 6 years later to year 21, it doubles from $400,000 to $832,000. That's why this YouTube channel is called Dividend Compounders with Cheese. Let me show you one more example where you have more aggressive contributions every single month. So in this example, let's say you start out with an initial $2,500 into your brokerage account and you contribute $1,500 or $1,500 every single month. And the timeline horizon is now 25 years. After 25 years of doing dividend growth investing, you will almost have $2 million. More accurately put, $1,906,948.51. And in a 365-day rolling period, you will get $42,659.40 in dividends. And that dividend payout is just going to grow year over year. Realistically, if you do this, it's going to take time to build a portfolio that can pay for your bills and expenses. For most of us, our expenses are going to be around $15,000 to $60,000 a year. So from our second example, getting $42,000 in dividends per year, this should cover all of our overhead costs, such as our mortgage, utilities, cell phone bill, internet bill, Netflix, etc. Slow and steady will win the race. Although, if you wear the Nike Alpha Flies, you might finish faster. In this dividend compounding sense, if you're able to put more savings into your dividend portfolio, like with the second example, it will help speed things up. I'm not going to tell you what to do with your money. We are all adults here. You can decide how much you can allocate. Some people literally live off of ramen and contribute nearly all of their paycheck towards their portfolio so that they can retire faster. Other people are enjoying life along the way and are putting what they can into the portfolio. Then there's people who aren't doing any form of investing. About 39% of American adults are not investing. You know yourself well. You know how old you are and what your timeline is. So act accordingly, please. If you were at my Thanksgiving table, I wouldn't tell you how much to eat or even say that your third plate is too much. So if you want to drizzle a lot of hot sauce and spend 45 minutes on the toilet, do you, boo-boo. Do you? Yeah, I'm not sure if that example made any sense. Just do what feels right according to your risk profile and your preferred retirement age. So let's talk about my recommendation. You can call it a day with investing in VTI or even SCHD. But if you like the idea of researching, analyzing, and investing in individual stocks, then make sure that those companies are high quality with an economic advantage and are a business that is efficient in their operations. Please avoid high yield dividend traps that are good for nothing but heartbreak after heartbreak. When you are interested in a stock, please do not fall in love with the price. Low price does not mean that the stock has more to grow or that it's undervalued. Because more often than not, a low price means that it has very diluted shares outstanding, it could have financial turmoil, or even be on a path to cut its dividend. Sometimes a $400 stock like Costco is a better buy than a $3 dividend paying stock. Also, one more thing to keep in mind is that just because a stock used to be $100 and now it's $10, it does not mean that it's undervalued. There is always more to the story. To look for quality dividend-paying stocks, look at the intangibles of the company, analyze the finances, and run some valuation models to really figure out if it's a worthy investment or not, if it's a delicious or a disgusting dividend stock. So in conclusion, why do I like dividends? Because sometimes a stock can trade sideways. It goes up and it goes down. So why not get a dividend in the meantime while it's doing a ballet routine? And as we learned earlier, dividends are real cash payments with a lower tax bracket treatment. That is, of course, if they are qualified dividends, which unless you are investing in REITs or BDCs, they should be. For some of us, those dividends will be taxed at 0% and others at 15 or 20%. As for next steps, go ahead and follow this channel because I will do deep dives and analyze companies to see if they are worthy of being delicious dividend companies that will compound. Anyways, I'll talk to you next time. Stay safe. Dividend Compounders with Cheese, signing off.